Here we are. Let's start with the real estate market because you're diving deep into some moves by Blackstone's B REIT, getting a major cash infusion from the University of California. What's going on there, and why is that something to pay attention to?
It's telling because when Blackstone's fund, which is the Blackstone Real Estate Income Trust, is $69 billion net asset under management, or net asset value, as they call it, fund. Pretty much private real estate holdings for the most part, some debt included in there, had massive amounts of redemption requests. For example, in the third quarter, they saw this is again, the $69 billion fund had $8.85 billion in redemption requests in the third quarter. A year ago, same third quarter of the previous year, 882 million. So there's a limitation on what you can get out. And that limitation is 2% of net asset value or 5% over a quarter. So way above that. A lot of that redemption interest came from Asia, but the fund doesn't have the liquidity. So they sold MGM Grand. They had a 49.9% interest in that. They had to sell that. They sold some other assets. And then they had to raise $4 billion in order to meet redemptions from the regions of California. And they got a very sweet deal, which is telling. They got 11.25% annual minimum net return for 6 years for that investment. So that they have to raise that much money and pay that much for that money is telling there are problems with the portfolio.
Okay, so where do you see the real estate market heading in 2023 after going down so much after those pandemic highs in the last year?
I think we're going to see trouble because if the Fed continues to raise rates, I don't care if they go to 25 basis points for one or two hikes, it doesn't matter. If they leave them elevated, if the terminal rate, whatever the Fed funds rate ends up being, is 5.5%, 6%, and they keep it for, say, a couple of quarters, a year or more, real estate is going to get absolutely hammered. And this is what we're seeing in this fund. So not only did they gate it in terms of not allowing the redemptions that they would normally allow, but cutting those off. But this isn't the only fund that's doing it. There are a lot of other funds, especially in Europe and specifically in the UK. BlackRock, the largest asset manager in the world, is gating a big UK fund and not allowing investors out of that at the normal redemption rate. And a couple of Threadneedle, a couple of other big firms that have big real estate holdings in UK and in Europe are starting to gate their funds. So it's not just in the United States. And as rates continue to rise here and are held higher, we're going to see the impact across the board on real estate across the country.
And not just interest rate shy, but I also want to ask you about just the Fed balance sheet itself, right? You have more than $2 trillion in mortgage-backed securities. So what role does the Fed play in terms of its assets and its balance sheet on the real estate market?
Good point. And we talked about this, I think, a couple of months ago. I think they have something like 2.4 trillion in MBS. And what we mentioned before, you and I talked about, is as interest rates have risen, the duration, the length of the portfolios has increased. So the Fed hasn't been able to sell because they're selling at a loss. If they're going to, well, not selling, they're allowing supposedly the runoff, but the runoff isn't happening off of their balance sheet because the duration's gotten longer. So they're staying on the Fed's balance sheet. The Fed cannot sell them, even though it wants to, because there's no market for them. The prices are being devastated. So this is what we're seeing right now in terms of mortgage-backed securities, and that's a reflection mostly on residential real estate. So more pain ahead.
All right, so what is the outlook difference between commercial real estate and residential real estate?
Well, commercial has got something of, I would call it a cushion in terms of institutional investor interest. As the prices come down, there's a lot of institutional money there that is going to gravitate towards that. We see that as yields have spiked, the bond market has rallied because investors are buying yields. It's the first time in a decade you can get any yield, whether it's on your cash or your fixed income investments. They're going to look at real estate the same way, especially the institutions, the pension funds. So as commercial real estate comes down, there's going to be something of, I'm not going to call it a soft landing, but there's going to be a cushion for it at some point, and you're going to start to see funds and institutional players start to pick up. Not the same case with residential. I think they're going to get hit harder, and partly because
Mhm.
of mortgage-backed securities.
All right, so we're 10 days into the new year. What stocks, what REITs, what other assets are you keeping an eye on for the real estate markets this year?
Across the board, whether it's commodities, whether it's lumber, whether it's building materials, all of those come into play here. And some of them had spikes. Some of them we know had just gone through the roof during the pandemic, have come back down. Some of them will bounce. Some of them will go lower. So there's a lot of different plays. There's some mortgage plays we're looking at. Also, the home builders are another area we're certainly concentrating on. There's going to be movement up and down there. So as far as 2023 goes, the residential real estate sector is going to be ripe for all kinds of opportunities, both for the long side and the short side. So we've got a lot of plays we're putting forward in my portfolio on that one as far as hyperdrive portfolio. That's going to be a concentrated area for 2023.
All right, so there's really no sign that the Fed's going to cut interest rates this year. So is the real estate market the best bet to make trades off of high interest rates?
It's one of the best bets to make for sure because it's like a glacier. It's slower moving, and there's more opportunities when you can see something down the horizon. It's like, it's going to take a while for this to happen or for us to get there, and allows you some time in a trade, for example. So that is going to mean that there'd be a lot of opportunities, both commercial, but more so, as I said, in residential. And that's just it's a sector that's going to be. You're going to hear a lot about it. And if rates are higher for a lot longer, there's going to be a lot of money to be made on the downside.
All right, Shaz. So let's say hypothetically that you're a person who watched the show in December and then maybe you vanished for 17 days and you just didn't come back. And then all of a sudden you show back up one day. But you're really interested in knowing more about the real estate market and how to trade your exclusive opportunities. What do I do?
Well, first thing is you want to read my totalwealthresearch.com article coming out on Thursday. It's about Blackstone and BlackRock and everybody that's having problems with redemptions and why. So that'll give you the big picture. But as far as hyperdrive portfolio goes, that's where we're making the real estate plays. That's where we're making all of these, whether it's mortgage-backed plays, interest rate plays, duration plays in the hyperdrive portfolio. That's where all the action is going to be.